20 finance terms you should know. If you understand these terms, you understand the language of money. Most people never learn this in school, but once you do, you see the world differently. Think of this as a foundation. When you get these terms, you understand investing, business, the economy, and wealth building on a deeper level. Asset. An asset is something you own that has value and can help you build wealth over time. Assets either generate income, appreciate in value, or do both. Examples include stocks, real estate, savings, businesses, and valuable items like gold. A car is usually not an asset because it loses value and costs money to maintain. True assets put money in your pocket. The goal of personal finance is to accumulate assets that work for you so your money grows even when you are not working. Liability. A liability is something you owe. It takes money out of your pocket, either now or in the future. Loans, credit card debt, car payments, and mortgages are all liabilities. Not all liabilities are bad, but unmanaged liabilities keep you trapped. Wealthy people use liabilities strategically when they help acquire productive assets, like using a mortgage to buy property that generates rental income. The key is understanding when a liability is helping you and when it is draining you. Net worth. Net worth is the difference between what you own and what you owe. The formula is simple. Assets minus liabilities equals net worth. Net worth is a better measure of financial health than income because someone can earn a lot but still be financially fragile if they also spend a lot or carry heavy debt. Building net worth requires increasing assets, decreasing liabilities, and consistently saving or investing more than you spend. Cash flow. Cash flow is the movement of money in and out of your finances. Positive cash flow means you earn more than you spend, while negative cash flow means money is leaving faster than it comes in. Cash flow matters because it determines your ability to invest and grow wealth. Even someone with a high salary can struggle if they have poor cash flow habits. The first stage of financial stability is mastering cash flow and living below your means. Equity. Equity represents ownership. In a home, equity is the portion you own after subtracting the mortgage. In a business or stock, equity is the ownership stake you hold. Equity grows as debts get paid down or as the asset increases in value. Over time, building equity in property, businesses, and investments can dramatically increase wealth. Wealthy individuals focus on equity, not just income, because equity compounds. Liquidity. Liquidity refers to how easily an asset can be converted into cash without losing much value. Cash in a bank account is highly liquid. Real estate is less liquid because selling it takes time and involves fees. Liquidity matters because emergencies and opportunities happen unexpectedly. Having liquid assets like savings or short-term investments protects you from needing to sell valuable long-term assets at a bad time. Compound interest. Compound interest is when the interest you earn also earns interest, causing your money to grow faster over time. Compounding rewards patience and discipline. The earlier you start investing, even with small amounts, the more powerful compounding becomes. It is the core engine behind long-term wealth. Time is as important as the amount you invest. Inflation. Inflation is the rate at which prices increase over time, reducing the purchasing power of money. A dollar today buys more than a dollar will in the future. Inflation can quietly erode savings if money sits idle. Investing is how you protect and grow purchasing power. The long-term average inflation rate is around 2 to 3%, but in recent years it has fluctuated higher, making investing even more important. Recession. A recession is a period of economic decline, usually marked by decreasing business activity, lower consumer spending, and rising unemployment. Recessions are part of the economic cycle and not permanent. The people who prosper through recessions usually have savings, low debt, skills that remain in demand, and the courage to invest when others panic. Bear market. A bear market is when the stock market falls 20% or more from recent highs. It reflects fear, uncertainty, and pessimism. Bear markets can feel intimidating, but historically, they have presented buying opportunities for long-term investors. Markets move in cycles, and every bear market in history has eventually been followed by a recovery. Bull market. A bull market is the opposite of a bear market. It is a period when stock prices rise consistently and investor confidence grows. Bull markets are when wealth builds quickly, but they can also lead people to take unnecessary risks or assume growth will continue forever. Investors who succeed long-term stay disciplined in both bull and bear markets. Diversification. Diversification means spreading investments across different types of assets to reduce risk. Instead of relying on just one investment, you hold multiple stocks, bonds, or assets like real estate or commodities. Diversification does not guarantee profits, but it protects you from catastrophic losses. Wealth preservation is just as important as wealth growth. Index fund. An index fund is a type of investment that tracks a market index like the S&P 500. Instead of picking individual stocks, you invest in a basket of companies at once. Index funds are low cost, diversified, and historically outperform most individual investors and many professional fund managers. For many people, they are the simplest way to build wealth over time. ETF. An ETF, or exchange traded fund, is similar to an index fund but trades like a stock. ETFs offer diversification, flexibility, and typically low fees. They can track broad markets, specific industries, or even commodities. ETFs are popular because they combine the diversification of mutual funds with the convenience of stock trading. Dividend is a payment that companies give to shareholders from their profits. Some investors build portfolios focused on dividend-paying stocks to generate passive income. Dividends can be reinvested to buy more shares or taken as cash. Over long periods, reinvesting dividends significantly boosts returns due to compounding. Capital gain. A capital gain is profit made when you sell an asset for more than you paid for it. Long-term capital gains from assets held over a year are often taxed at lower rates than regular income. Understanding taxes on gains helps investors make smarter decisions about when to buy or sell. Credit score. A credit score measures your reliability as a borrower. Higher scores give access to lower interest rates, better loan terms, and financial flexibility. Credit is not just about borrowing. It can affect housing, insurance, and job opportunities. Responsible credit behavior saves large amounts of money over time. Leverage. Leverage means using borrowed money to increase potential returns. It can amplify gains, but it also increases risk. Investors, businesses, and even governments use leverage. Used wisely, it accelerates wealth building. Used recklessly, it leads to debt problems or financial failure. Control leverage, do not let it control you. Margin is borrowed money used to invest in financial markets. It magnifies both profits and losses. Margin trading can be powerful but dangerous without discipline and knowledge. Many major market collapses and individual financial disasters involve excessive margin. Beginners should approach margin cautiously or avoid it entirely. Risk tolerance. Risk tolerance is your personal ability to handle fluctuations in value without panic. Some people can hold through market volatility, others cannot sleep when prices fall. Knowing your risk tolerance helps you choose investments aligned with your emotional and financial capacity. The best investment strategy is one you can stick to for decades. These finance terms form the basis of understanding money, investing, and wealth. The more fluent you become in this language, the more confident and prepared you are to navigate the financial world. Wealth is not only about earning money, it is about knowing how money works, using it intelligently, and letting time work in your favor.